Welcome to this explainer. Look, today we're going to fundamentally shift how you look at your charts. No more missing out on those massive market moves. I am absolutely thrilled to get into this with you because what we're covering, it's going to save you literally years of frustration. We're going to break down exactly how I spot winning trades with one easy overriding rule. So, ever missed a massive trade just because of some tiny, annoying imperfection? We've all been there, right? You feel that deep, gut-wrenching frustration of watching a perfectly planned trade just sail right past your pre-drawn zones simply because it didn't hit the exact pixel you wanted. You know the drill. You draw your lines, you wait patiently, price gets close, maybe pushes a tiny bit past it or stops just short, and then boom, it blasts off in your predicted direction without you. It's maddening. But it happens because of a very specific mindset trap. All right, let's dive right into it. This is the golden rule. It's the anchor mantra we're going to be repeating throughout this entire explainer. Trade what you see, not what you want. Now, I know it sounds super simple, but actually applying it, that is where the magic happens. Look, the market is this stubborn force of nature. You can't control it. You can only react to it. If you're just sitting around waiting for the market to do exactly what you want it to do, you're going to miss out on basically 90% of the best trades. Today, we're going to turn you from a rigid predictor into a fluid observer. We'll be looking at 4 specific scenarios: imperfect zones, invalidated zones, price action reaction, and finally, correlated crypto trades. All right, let's kick things off with Section 1, imperfect zones and trading within the mess. So, picture the Aussie dollar on the 4-hour time frame. You've got your key zone drawn up from previous reversal points, price comes back down to the zone, but it breaks slightly through it. Now, a lot of traders would look at that and say, nope, didn't stop right at my line, the trade's invalid. And honestly, that is a huge mistake. You're expecting price to do what you want. Instead, we trade what we actually see by looking for confluence. First up, we spot a recent double bottom long trade setup. That's our trigger event, giving us that upwards momentum and a bullish bias. Second, as price approaches our somewhat messy zone, we see shrinking candles followed by a color change. That signals momentum loss in the pullback. Third, check this out. Price respects our key moving average for 3 candles in a row, right at our key support and resistance area. And fourth, if we pull our fib retracement, the pullback is perfectly situated within that 50 to 61.8% value zone. If you had just passed because the zone wasn't picture perfect, man, you would have missed a massive moving uptrend. And this perfectly illustrates a crucial point when we also saw play out on the Euro-Dollar 1-hour chart. You absolutely have to treat the zones you draw as general areas of value, not these exact unbreakable lines in the sand. On that Euro-Dollar chart, price created a divergence in the general area of the key zone, not exactly pinpointed on it. There was no immediate breakout, the whole thing looked kind of messy, but because it was a moving uptrend, that divergence in the general area was our signal. You've got to adapt to the imperfections, wait for the higher high breakout to confirm the divergence, and then you just catch the trend. Moving right along to Section 2, invalidated zones. Or, in other words, clearing the clutter. Let's see how this whole concept builds when a zone just completely fails, like we saw over on the dollar Swiss 4-hour chart. Price invalidated our drawn key zone not once, not twice, but 3 separate times. I mean, when price chops right through your beautifully drawn zone 3 times like that, it is screaming something at you. It's saying, hey, for this current time period, the market just does not care about this zone. So what do? We disregard it. We just delete it. Notice the stark contrast here. If you stubbornly leave that broken zone on your chart, it just creates clutter and confusion. It literally acts as an artificial mental barrier. But the second we delete it, we clear the way for new key levels to form organically. By trashing that dollar Swiss zone, we clearly saw a brand new inside bar setup form at a lower swing low reversal point. And actually, the exact same thing happened on the Euro-Yen 4-hour chart. A previous zone was getting chopped through, so we removed it. And what did that reveal? A beautiful new triple bottom support zone. Price came down to it, gave us shrinking candles, a color change, and a nice long wick reaction. If that old invalidated zone was still hanging around, you definitely would have hesitated. But deleting it, that allowed us to zoom into the 30-minute time frame, spot a descending channel and divergence, and comfortably enter the reversal the second the pattern broke upwards. Let's transition over to our third scenario, price action reaction. Letting the market decide. So what is price action reaction? Well, it simply means waiting for price action to occur at a specific zone to actually validate it before you even think about taking a trade. We see this perfectly illustrated on the dollar-yen 4-hour chart. You might have two distinct, perfectly valid support zones drawn up, both based on previous reversal points. Now, as price comes tumbling down, you have absolutely zero clue whether it's going to bounce off zone 1 or zone 2. And here is the secret: you don't need to know. Instead of guessing, you just wait. You let price come down and you watch. On the dollar-yen, price dropped, formed an inside bar, changed candle color, and then printed a long wick candle at one of those zones. Boom! That reaction validates the zone. Once you have that higher timeframe validation locked in, then you jump down to your lower intraday timeframes, like the 30-minute, and you hunt for structural confirmation, like a wedge pattern breaking out to the upside to confirm that trend change. So you see how it all comes back to our central theme? Trade what you see, not what you want. If you really wanted price to bounce at that top zone, but it just sliced right through it without any bullish price action whatsoever, you do nothing. If it then reaches the bottom zone and hands you that inside bar and long wick reaction, well, your trade opportunity has simply moved down there. You react to the market's decision. You do not try to predict it in advance. Finally, let's look at a fascinating application of this rule in Section 4. Correlated crypto trades and the anchor effect. Okay, so what happens when a massive asset like Bitcoin pulls back on the weekly time frame, but it doesn't quite reach your perfectly drawn key value zone before it just launches into a massive upward bull run? Honestly, a lot of traders sat that out entirely because it didn't hit the exact line they wanted. But if we're trading what we see, we flip over to the daily chart. On the Bitcoin daily time frame, before it could even reach that weekly zone, it printed back-to-back divergence and successfully broke above a major downward trend line. That right there confirms a trend change. It's the market telling us, hey, the pullback is over and the moving uptrend is resuming. And this is exactly where correlated assets come in. You don't have to trade expensive Bitcoin directly. You can use alternative pairs, like Ether, that move in tandem with your anchor asset. So the structured flow for this looks a little something like this. First, you identify that trendline break and divergence on your anchor, in this case, Bitcoin. Second, that confirms your bullish directional bias for the overall crypto market. Third, you go find a cheaper correlated pair, like Ether. And finally, you look for a similar setup, like a trendline break on Ether itself, and enter using your key entry strategy. You see, you didn't force Bitcoin to hit your perfect zone, you observed its bullish signals, and you used it as an anchor to confidently trade a correlated asset. So as we review our roadmap today, imperfect zones, invalidated zones, price action reaction, and correlated crypto trades, the overarching lesson across every single one of these charts is clear. Demanding perfection, it's just going to make you miss out on the best moves the market has to offer. To wrap up this explainer, I really want you to burn these 4 bullet points into your memory. These are the concrete ways you're going to apply our golden rules starting today. 1. Accept the imperfections and look for confluence within general areas of value. 2. Delete those chopped up, invalidated zones to clear your mental clutter and reveal the real setups. 3. Wait for the market to give you a price action reaction to validate a zone. Seriously, stop guessing. And 4. Observe your anchor assets to confirm a broader bias so you can capitalize on correlated pairs even if the anchor didn't hit your exact target. I'm going to leave you with this final, absolutely crucial question. The very next time you open your charts, I want you to look at your lines, look at your setups, and ask yourself honestly, am I predicting the market or am I actually observing it? Because the moment you finally let go of what you want the market to do, you unlock the secret to trading what you actually see. Thanks so much for joining me for this explainer, and I really can't wait to see how you apply this to your own charts.